The risk disclosures appearing on the screen are important for you to read and understand. Please pause the video now to read through the disclosures, or listen in as the disclosures are read aloud at the conclusion of this video.
This is Don DeBartolo, a senior commodities broker with Daniels Trading in Chicago. I am the editor of the Trade Spotlight Options Advisory Service. This video series should instill confidence in trading commodity options. This particular video will focus on selling or writing option contracts. Let's bring in a chart of the December 2012 Kansas City wheat market. As a result of widespread drought in the states, agricultural grain commodity prices soared in the summer. In the fall, prices began to level off, particularly Kansas City wheat. The December 2012 contract was range-bound between the 12-month contract high of $9.57 and a low of $8.74 even. Reviewing the chart in mid-September, the trend was neutral, technical indicators were undecided on market direction, and the 50-day and 20-day moving averages were converging to the current price level. With these market conditions, I recommended a strangle strategy. A strangle is a trading strategy that aims to take advantage of a market with high probability that futures will expire within a range. A strangle requires simultaneously selling a call and selling a put on either side of the range. As the option seller, premium is collected. For example, the December 2012 1050 call could be sold for 9 7/8 cents. The December 2012 $8 put could be sold for 5 1/8 cents. Option point values are the same as the underlying futures market point values. In Kansas City wheat, it's $50 per cent. The 15 cents total, minus commissions and fees, would be credited to the cash value in the trading account. Each trading day, the cash value would be marked to market the difference to the current premium price of each strike. A short option position can be liquidated by buying it back, or the contract can be left to potentially expire worthless, collecting the full premium in the process. The reward potential is limited to the premium collected, while the risk potential is unlimited. Take a look at the potential risk on the strangle. As the underlying futures price approaches and then exceeds either strike, the theoretical value of one side increases at a faster rate. Buying back the option contract at a higher premium price than originally sold would result in a loss. Also, there are no fill guarantees, as option trading is not a one-to-one move like the underlying futures contract. It's also very possible to be unable to liquidate a short option position due to lack of trading volume, overnight market activity, or a black swan event. In addition, option sellers are obligated to the written strike price. At any point, an option seller can be assigned the underlying futures contract. If you sold a call option, you would be assigned a short futures position from that strike price. If you sold a put option, you would be assigned a long futures position from that strike price. So with limited reward but unlimited risk potential, why would one want to write commodity options? As discussed in my contract logistics video, option trading is a zero-sum game, meaning for each buyer, there must be a seller. Separate studies conducted at the CME and the CBOE in the late 90s revealed that 80% to 85% of all options that actually go to expiration are out of the money and therefore will expire worthless. Thus, if you're an option buyer and you did not liquidate your contract before expiration, there's only about a 15% to 20% chance that you can profit on your position. Based on the number of option contracts still on the market, then the seller of that option is potentially profitable 80% to 85% of the time. There are factors to take into consideration when writing option contracts. Take into consideration the distance of a strike to the current at-the-money strike. Delta values decrease in opposite direction of the at-the-money strike. Delta, as discussed in the contract logistics video, is the value at which the premium price will change based on the corresponding change of the underlying futures contract. The lower the delta, the less susceptible the premium is to fluctuate as the future price changes. That is true if the gamma of that strike price is also low. Gamma, another Greek, is the change in delta relative to a change in the underlying futures contract. The less the fluctuation of the premium price, the more likely you will be able to hold the position to option expiration. Take into consideration the days until option expiration. As covered in the contract logistics video, the premium price is made up of intrinsic value and time value. Part of time value is the implied volatility. Implied volatility represents the potential change in price due to the volatility of the underlying futures price over the option contract's life. The rise and fall of implied volatility will determine how expensive or cheap time value is to the option. An opportune time to sell an option contract is when the implied volatility level is high, as the premium price should be on the expensive side of the scale. As a writer of option contracts, you inherently have exposed and unlimited risk. However, the risks involved with selling options provide the opportunity to take advantage of market inefficiencies. In the next video in this series, I will introduce a trading strategy to help limit the risk of selling options. Until then, happy trading.
The risk of loss in trading futures contracts or commodity options can be substantial. You should carefully consider whether such trading is suitable for you in light of your circumstances and financial resources. You should read the risk disclosure webpage accessed at www.danielstrading.com at the bottom of the homepage. Daniels Trading is not affiliated with, nor does it endorse any trading system, newsletter, or other similar service. Daniels Trading does not guarantee or verify any performance claims made by such systems or services. When investing in the purchasing of options, you may lose all of the money you invested. When investing in the purchasing of options, you may lose all of the money you invested. When selling options, you may lose more than the funds you invested. This material is conveyed as a solicitation for entering into a derivatives transaction. This material has been prepared by a Daniels Trading broker who provides research market commentary and trade recommendations as part of his or her solicitation for accounts and solicitation for trades. Daniels Trading, its principals, brokers, and employees may trade in derivatives for their own accounts or for the accounts of others. Due to various factors, such as risk tolerance, margin requirements, trading objectives, short-term versus long-term strategies, technical versus fundamental market analysis, and other factors, such trading may result in the initiation or liquidation of positions that are different from or contrary to the opinions and recommendations contained therein. For customers trading options, these futures and forex charts are presented for informational purposes only. They are intended to show how investing in options can depend on the underlying futures prices, specifically whether or not an option purchaser is buying an in-the-money, at-the-money, or out-of-the-money option. Furthermore, the purchaser will be able to determine whether or not to exercise his right on an option, depending on how the option strike price compares to the underlying futures price. The futures charts are not intended to imply that option prices move in tandem with futures prices. In fact, option prices may only move a fraction of the price move in the underlying futures. In some cases, the option may not move at all or may even move in the opposite direction of the underlying futures contract.